Gold didn't just tick higher here. It flipped a switch, and now the loudest voices in the room are trying to reframe it as a temporary mood swing so you don't notice what Wes actually tightening underneath. Because when gold accelerates the way it has lately, the story almost never starts with a headline. It starts with plumbing. It starts with timing. It starts with the parts of the market that don't care what you believe, only what you're forced to do. And before this is over, I'm going to give you the one level that matters, the two scenarios that decide whether this turns into a controlled grind or a squeeze, and the next week checklist that keeps you from getting emotionally baited into selling the exact candle the market is designed to shake out. Here is the mistake most people make when gold runs. They treat it like a single price on a screen, one line, one chart, one emotion. But gold is a layered system. Spot, futures, forwards, options, physical premiums, warehouse deliverability, and cross-border arbitrage all pulling on the same rope. And when that rope starts to snap tight, the first clue is rarely in a soundbite. It's in the spreads. It's in the calendar. It's in the way the market behaves on tiny dips that should have been bigger. And that's where the real pressure starts. Right now, you can feel it in the way hard assets are being bid as a package. Gold moves, silver starts to lean in, and suddenly the "it's just fear" narrative feels thin. Because when silver wakes up alongside gold, it's not just a shiny metal story. It's liquidity. It's positioning. It's the market saying, this isn't one trade, it's a regime. But that's not the part that matters. The part that matters is what this move is forcing the other side. The side that provides liquidity, writes options, runs basis books, and manages collateral, to do in real time. So let's talk about the conflict you're going to be fed. You'll hear that gold is rallying because of one clean reason. Inflation, war, politics, a weak dollar, a dovish central bank, a scary headline. Pick your flavor. And yes, any one of those can light the match. But gold doesn't keep running because a match exists. Gold keeps running when the market structure turns the match into a feedback loop, when hedges become buys, when inventory becomes timing, when paper supplies won't show up at the speed the market is demanding delivery exposure. And the next detail is what flips the whole setup. The hidden detail, the underappreciated mechanism that reframes everything, is that gold's truth often shows up not in the headline price, but in the tension between paper and physical timing. In other words, the price can look calm while the cost of getting metal or getting guaranteed exposure when it matters quietly climbs. That can show up in forward rates, in lease dynamics, in near-month tightness versus deferred months, in the way exchange for physical style demand pulls on futures, or in regional premiums that signal actual urgency. You don't need to memorize the jargon. You just need to understand what it forces participants to do. Because if timing tightens, the market stops being a debate and starts being math. Here's the clean mechanics version. Futures are promises for future delivery exposure. Spot is what's now. Forwards and swaps are the bridge used by banks, dealers, and big players to transform one form into another. Options sit on top like a pressure system. When price moves toward big strike levels, the dealers who sold those options often hedge by buying or selling the underlying. That's delta hedging. And when the market sits in a zone where hedging flows reinforce the move, especially into key strikes, price can rise not because everyone suddenly became a gold bug, but because the system is mechanically forced to chase. And that's not theory. That's how reflexive markets behave when liquidity thins. Now add the calendar. Why now matters because timing is the catalyst that turns interest into urgency. This is the part retail often ignores, and institutions never ignore. January is famous for rebalancing and new allocations. Month end is famous for positioning cleanup. And right now we in a part of the calendar where liquidity can be thinner than people expect, while macro events like central bank meetings, inflation prints, and auction schedules can change rate expectations quickly. That combination, thin liquidity plus macro catalysts plus big option open interest, is the perfect recipe for fast, emotionally violent price action. And if you don't prepare for that, you'll confuse noise for signal and get played. Let's build the proof stack, layer by layer, the way professionals do it. First layer, the chart behavior that screams demand is real. When gold is in a true momentum phase, it stops giving you comfortable pullbacks. Dips get bought faster. Intraday sell-offs struggle to follow through. The market starts printing higher lows that feel annoying because they deny both sides what they want. Shorts done to get the breakdown, and patient buyers don't get the discount. That kind of structure is a tell. It's not a guarantee, but it's a tell. Because in a normal market, supply shows up on rallies. In a stressed market, supply shows up too late. Second layer, the term structure signal. In calm conditions, gold often carries a gentle cost of carry feel. Time costs something, storage and financing exist, and the curve reflects that. But when urgency appears, the curve can flatten or even hint at near-term tightness relative to deferred contracts. You don't have to stare at a complex curve all day, just know what it implies. If near-term demand is strong enough, the market pays up for immediacy. That's the market admitting, quietly, that timing is valuable. And if timing is valuable, arbitrage desks and physical players respond. But that response isn't instantaneous. It has frictions: logistics, refining, bar sizes, vault locations, and the reality that not all inventory is equal. Because if this one point lands, the math changes. Third layer, inventory reality. People love waving around warehouse numbers as if they're the answer. They aren't. Inventory categories matter. Deliverable metal is not the same thing as metal sitting somewhere that can easily be delivered against the contract you are looking at. Eligible versus registered, deliverable versus non-deliverable, bar specs, location, and ownership constraints all matter. In tight windows, the available now category is what drives stress, not the exist somewhere category. That's why you can see a market that looks fine on paper while the short-term cost of certainty rises. And that S, where paper versus physical tension, becomes a real factor without needing to accuse anyone of anything. It's not a conspiracy, it's incentives and constraints. Fourth layer, institutional flows. When gold is moving in a way that attracts real capital, the marginal buyer is often not someone buying coins after a scary clip on social media. It's allocation, it's portfolio construction, it's risk management. ETFs and ETPs are a conduit for that. When flows turn positive and persist, it changes the baseline demand profile. It forces sourcing, hedging, and inventory management to adapt. It also changes the behavior of trend-following systems and volatility targeting strategies. And those strategies don't believe anything. They respond. If trend strengthens and volatility stays manageable, they add. If volatility spikes and trend breaks, they cut. That mechanical behavior can amplify both upside and downside. And the next detail is what turns that into either a grind or a squeeze. Fifth layer, cross-market confirmation. Watch silver, not because it's a crystal ball, but because it's a higher beta stress test. Silver is thinner, more volatile, more sensitive to flows and positioning, and it often reacts more violently when the complex is genuinely bid. If silver starts moving with conviction, it's telling you something about liquidity and breadth. It can also pull attention and capital into the whole metals complex, which then feeds back into gold. And when the complex moves together, it gets harder to dismiss it as one isolated story. Sixth layer, the macro driver that actually matters. People argue endlessly about whether gold likes inflation, hates inflation, loves real yields, hates real yields, correlates with the dollar, doesn't. The cleaner way to think is this. Gold prices the credibility of the currency path and the stability of real purchasing power across regimes. It's less about one data point and more about how the market perceives policy constraints. If the market starts to believe central banks are boxed in, that they can hike as much as needed, can't cut as fast as hoped, or can't maintain credibility under pressure, gold benefits. Not because it's magical, but because it asks the asset that doesn't require someone else this promise to stay intact. And that's where the institutional mind goes when trust premiums rise. Now let's talk about the force trying to suppress or deny the move, without turning this into cartoon conspiracy talk. The suppression isn't a secret committee. The suppression is narrative pressure. It is the constant attempt to reduce a structural move into a single emotional cause, so the public treats it as temporary. If it's just fear, you can ignore it. If it's just a headline, you can dismiss it. If it's just a bubble, you can wait for it to pop. That framing protects the status quo because it keeps you from seeing the mechanism. When the system begins repricing trust, hard assets don't need permission, they just get bid. And when that bid meets constrained timing, the market starts to behave differently. But that's not the part that matters. The part that matters is what breaks the move. So let's be credible. Could this fail fast? Absolutely. And the failure mode is specific. If the dollar rips higher decisively, if real yields surge sharply, if risk assets puke in a way that forces broad liquidation, or if policy communication suddenly convinces the market that restrictive conditions will remain firm without credibility damage, gold can get hit hard in the short term. Also, if the move has been heavily option-driven, a shift in dealer hedging flows can reverse momentum quickly. That's why you don't marry a narrative, you watch the tells. Because even if the thesis is right, the price can whip violently. And that volatility is not a bug. It's the mechanism the market uses to harvest weak hands. Here's how the volatility trick works. You get a strong push-up. Then you get a sudden downdraft on an innocent headline. It feels like the story changed. It didn't. Liquidity thinned, stops got triggered, and someone needed to rebalance risk. Then you get a sharp snapback that makes you feel stupid if you sold. That emotional whiplash is designed not by a villain, but by market structure. Leverage participants, option hedging flows, and thin order books create air pockets. The market punishes certainty. It punishes emotional leverage. It punishes anyone who needs price to behave politely. And the next detail is how you defend yourself. You defend yourself by separating trend signal from noise and by predefining your invalidation, not your hope. Trend signal is the market holding key breakout shelves on pullbacks and continuing to attract bids on weakness. Noise is intraday violence that doesn't change the structure. If you can't tell the difference, you'll react to noise as if it's truth. That's how you get chopped. So you build a simple map. Not a prediction, a map. Here's the map, and I'm going to keep it concrete without pretending I have a crystal ball. There are two scenarios from here. Scenario one is the controlled pullback and retest. Gold cools off, it gives back a portion of the recent sprint, and it comes back to test the breakout area, the zone where the market previously struggled and then cleared. In that scenario, you want to see dips get bought on higher lows, you want to see the dollar's strength fail to translate into sustained gold weakness, and you want to see spreads and near-term demand indicators remain firm, even while the headline price breathes. This is the scenario where people call it over, and then it quietly resumes. The confirmation is boring strength. The invalidation is clean, sustained breakdown below the breakout shelf with follow-through selling and improving confidence in cash and real yields. Because if that shelf breaks, the math changes. Scenario 2 is the continuation squeeze with gap risk. Gold doesn't give you the polite retest. It compresses sideways, volatility tightens, and then it launches again, often into a cluster of option strikes, or into a macro event window where hedging flows can accelerate the move. This is where you see dips that last minutes, not days. This is where you see silver and the miners start acting like they're sniffing something bigger. This is where paper supply feels like it's stepping aside, not because it disappeared, but because it can't lean against a tape that's being mechanically reinforced. The risk here is obvious. You can get air pockets both up and down. You can get a weekend gap. You can get a policy headline that prints a candle before your brain catches up. This scenario is powerful, but it's also the scenario that psychologically destroys people who chase without a plan. And the next detail is what to watch next week, so you're not guessing. So what are the tells for the next 1 to 2 weeks? Watch 3 categories: levels, structure, and plumbing. For levels, you care about the most recent breakout zone and the most recent swing low that defines the move, IOS integrity. Think of it as a floor and a line in the sand. The floor is where buyers must show up if momentum is real. The line in the sand is where, if price lives below it for more than a quick flush, the move is no longer a healthy trend and becomes a different setup. You don't need exact ticks, you need zones. If gold is holding the breakout shelf and building higher lows, the trend signal is alive. If it breaks and fails to reclaim, you respect that. Not because you're scared, because the structure changed. For structure, watch how gold behaves when the dollar has a strong day or when yields jump. In a weak gold market, those moves crush gold. In a strong gold market, those moves cause only contained pullbacks and the bid returns. That divergence is a tell. It's the market saying, even when the usual headwind shows up, demand doesn't vanish. And that's where the real pressure starts. For plumbing, watch the stuff people hate watching. Near-month tightness versus deferred months, any signs of persistent physical premiums in key regions, the behavior of silver relative to gold, and the overall volatility regime. If implied volatility rises while price rises and the market still can't push it down, that's often a sign of stress and demand for protection, which can feed dealer hedging dynamics. If volatility collapses while price drifts up, that can also be constructive because it allows systematic strategies to add without being forced to cut. Both can work. What you don't want is a volatility spike paired with a structural breakdown. That's the liquidation setup. Now let AES make this more real. Why are investors rushing to hard assets in a way that feels different from a normal dip buy? Because hard assets are a response to uncertainty that isn't easily hedged. Not uncertainty about tomorrow's headline, but uncertainty about the stability of long-run purchasing power, policy constraints, geopolitical alignment, and the real value of collateral. In that environment, gold becomes less about making money and more about maintaining options. It is a form of insurance that can go into price discovery mode when enough players decide they need it simultaneously. That simultaneously part is what creates momentum. And momentum in gold is not just a vibe. It's mechanics plus flows plus psychology. Mechanics, futures and options hedging can force buying. Flows, institutional allocations can sustain demand. Psychology, the public gets shaken out by volatility while the professionals use that volatility to build positions. You see the pattern in almost every major hard asset move. The market rises, the narrative lags, then the narrative catches up right near a pullback, and that pullback becomes the emotional trap. It's over. Then it isn't. But that's not the part that matters. The part that matters is how you keep your brain from becoming liquidity. Here's the viewer psychology shield in practical terms. First, don't anchor your conviction to one day's candle. Gold can drop hard even in a bull phase because leveraged players get margin called, because dealers rebalance, because macro tape jolts. A sharp drop does not equal thesis dead. It equals volatility. Second, don't confuse social proof with proof. When everyone suddenly agrees on the reason gold is up, that's usually late. The market moves first, then the story gets written. Third, don't let price action bully you into emotional leverage. The fastest way to get destroyed is to size so large that normal volatility forces you to make decisions at the worst possible time. You want the ability to be patient. Patience is a position. And that's where the real pressure starts. Now, the hidden detail again, because it's the anchor. When the market's demand for timing rises, it changes behavior. If there are signs that near-term delivery exposure is being valued more, if physical premiums persist, if the curve behaves differently than it should, it suggests the move isn't only speculative. It suggests there's a real-world bid for certainty. That doesn't mean shortages. It doesn't mean doom. It means the marginal unit of right now is being repriced. And when that happens, the paper market can still trade enormous volume, but the marginal price can be set by the urgency of those who need certainty. That's not drama. That's how commodities behave when timing gets tight. So what comes next? In the immediate future, expect attempts to shake you. Expect headline-driven spikes. Expect quick dips that feel personal. Expect people to suddenly discover reasons gold should be down. That's the process. If gold is in the controlled retest scenario, it may look like a failure before it looks like a continuation. If it's in the squeeze scenario, it may look unstoppable, right before it throws a violent rug to test conviction. That's why you don't worship the candle. You watch the shelf. You watch whether dips are bought. You watch whether the usual headwinds actually work. You watch the plumbing. And if you do that, you stop being reactive. Let me give you a simple checklist you can actually use. 1, is price holding above the breakout shelf on closing bases, not just intraday? 2, do pullbacks fail to gather momentum, with buyers stepping in earlier than expected? 3, do cross signals like silver and the broader metals complex confirm rather than contradict? 4, does the dollar or yield strength fail to translate into sustained gold weakness? 5, do the timing signals, the stuff that hints at near-term demand, stay firm while the tape breathes? If most of those are yes, the move has structural support. If most of those flip no, you tighten up and stop pretending. Because if that one level breaks, the math changes. And one more thing, if you're the kind of investor who distrusts institutions, don't fall into the trap of thinking they're omnipotent. They're not. They're constrained, they manage risk, they hedge, they rebalance, they have mandates. When the regime shifts, they adapt. Sometimes that adaptation looks like suppression because they don't validate your emotions. But the real story is simpler. Incentives create behavior. When trust premiums rise, hard assets get bid. When volatility rises, risk desks tighten. When options are loaded at key strikes, hedging flows matter. When liquidity thins, candles get violent. You don't need a villain, you need a model of behavior. And that model is why gold momentum can ignite and sustain even when people are skeptical. Skeptics are part of the fuel. When the market climbs while skepticism remains, it means there is still a pool of reluctant buyers who will become buyers later if price forces them. That can be portfolio managers who are underallocated. It can be hedgers who delayed. It can be shorts who got comfortable. It can be macro traders who need to neutralize exposure before a big event window. That reluctant pool is why momentum can keep surprising people. But it also means the move can be sharp because when that pool is forced to act, it doesn't act gently. So here's the final takeaway. This gold move isn't just emotion, it's math meeting calendar, it's mechanics meeting flows, it's trust premiums meeting timing. The market is repricing the value of certainty, and the noise is going to be brutal precisely because the setup is real enough to attract big money and contested enough to stay volatile. If you want to navigate it like a pro, you don't need a prediction. You need a framework, a level, and a plan for 2 scenarios. And if you are really the kind of person who wants the next week checklist and the mechanics explained without the propaganda, you already know what to do. Stay with the people who watch structure instead of headlines and keep your ego out of your risk management. Because the market will always try to turn your emotions into someone else's entry, and that's where the real pressure starts.